Welcome back. You're watching the first show of Traders Corner for 2018, and joining me all bright-eyed and bushy-tailed is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome and Happy New Year.
Yes, thanks, Julieta. Hi, welcome back to you as well, and let's hope this is going to be a great year.
Yeah, and a better year, I suppose, not to remind ourselves too much of 2017, but it was really tough, and there are a few changes that we're going to start off with, and as we always start off the show, just a reminder of what it's about and how much capital you're actually going to allocate to your trading this year.
Yes, that's it. So Traders Corner is effectively, it's real life trading. I put up some of my own money to capitalize the show, and we trade with that money on the show. So we provide analysis, we look at opportunities, we do real trades with the money, and then at the end of the year we donate whatever profits we've made to a charity. So in years gone past, we've typically put up 250,000 Rand and traded that throughout the year. We've had some very good years over the year. We've had a couple of average years, last year being one of the sort of more disappointing years. Yep. But that was last year, and let's look more positively to this year. What I'm doing this year that's slightly different is I'm upping the stakes a little bit. I've put 150,000 Rand into a local portfolio, which we will trade, and then I'm allocating $15,000 to an offshore portfolio. Yeah. Last year we did begin looking at some offshore ideas, and this year we're going to take that theme further. So we'll look both locally and offshore. And you know, I'm becoming more and more interested in the offshore markets. I'm starting to do more of my own trading on the offshore markets, and it's accessible for viewers. Now, you can open an account with any one of a number of brokers locally. You can put up to R1 million a year into an offshore account using your discretionary allowance without needing to get tax clearance approval, so it's relatively easy. You know, so I know a lot of people think that it's a huge hurdle to jump over to try and get money offshore and to open an offshore trading account. It's actually not that difficult if you just try, and it's really not that difficult to do. So as a consequence, we're going to look to try and explore that and try and explore offshore opportunities as well as local opportunities.
I mean, you know, there's the universe, a huge universe of stocks to buy offshore, which, and so it sounds, and it is very tempting. It's not always been that easy, and last year was, I suppose, our first of baby steps into that offshore trading arena. It didn't always work out that well, yeah. But I suppose, you know, you've got to start somewhere.
Yeah, last year a lot of my focus was actually on the UK market. We had pounds which we allocated into an offshore account, and a lot of what I did was in UK stocks, and we also did quite a lot of options on the S&P 500. The FTSE market, the generally stocks that constitute the FTSE 100 I found are actually incredibly boring for the most part, and this year I'm going to be rather looking towards the S&P 100. Okay. I find that the stocks on the US market move around a lot more. They're a lot more exciting, they're a lot more interesting, and as a consequence of that, that's where I'm kind of shifting my personal trading focus to try and explore opportunities.
Okay, so then what are your goals for 2018?
Right, so a lot of these goals are the same goals that we come up with each year, but I've actually changed the third goal, if you will. So to go through them, 2 out of 3 trades I want to be winners. So 66% of our trades I want to be winners. Why say 2 out of 3 and not 3 out of 3? Well, because in reality nobody gets all their trades right. You do get some trades wrong. So 2 out of 3 to me is a good number to aim for. I want my winners to be 3 times bigger than my losers on average. Now, regular viewers will know that when we set out the risk that we're willing to take on trades, we don't want to risk more than 2% of our capital on any given trade. So if I can get winners 3 times bigger than that, then what it would effectively mean is that for every 2% of capital that we risk, we aim to try and make a 6% total return on capital on a winning trade. And then the last one is that I want to be more active this year, but I also want to trade very precisely. Last year I wasn't active enough, and this year I actually want to set for myself a goal to ensure that we complete 30 trades this year, at least 30 trades, if not maybe even a little bit more.
Is that not a bit prescriptive, Garth?
It might be, but it's something I've given a lot of thought to over the holiday period, is that actually last year I know on the show and in my personal capacity I actually wasn't active enough in the market. And given that we're looking at the local market as well as the offshore market, there's definitely 30 trades in a year that you can do. I mean, there's way more than 30 trades, but we obviously only record this show once a week. Yeah. So it effectively means that we're going to be taking a trade every week or two. We should be taking a trade on average. And there's no excuse not to. There's plenty of opportunities out there given the broad universe that we're going to be watching for the show this year.
Okay, so talking about that broad universe, it helps to see what's going on in the world out there. And viewers will recall that just about every show last year we started with a look at the S&P 500, which was a phenomenal performer and has continued in the very same vein. In fact, even more so, even more exaggeratedly so, in the first couple of weeks of 2018.
Yeah, that's right. You're right that we do typically look at the S&P 500 at the beginning of each show. I'm going to sort of veer away from that, I think, this year, because I got the feeling last year that the show became a little bit too stale, and we always looked at the S&P 500 and then the top 40, and it was the same thing every week. I'm going to try and make it a bit more punchy this year, so I'm going to rather focus on where the opportunities are. So don't expect to necessarily see the S&P 500 every single week on the show.
Although it is a beautiful chart.
It is a beautiful chart, and this is one of the things. I mean, we're sketching the landscape now and sort of some expectations for the year in 2018. And part of the landscape is looking at this S&P 500 and where it is at the moment. And I look at this because simply it is the world's biggest stock index, and it's the US top 500 companies in the US. But what's particularly notable here is the acceleration in the rising trend here. So yes, it is a beautiful chart, but it does starting to look a little bit too aggressive to the upside, if you will. So notice how the trend line has steepened and steepened and steepened. And now you're in a situation now where that primary trend from the beginning of 2017 back there is quite a long way down, down at 25.50. I mean, that's a good 250 points below where the index is currently trading. Then you've got the steeper trends that have begun to emanate from that. And that starts to look almost a little bit blow-off-ish to me now. I mean, if we think of the most recent blow-off, it's obviously Bitcoin, which is, it went steeper and steeper and steeper, and eventually it went so steep the chart almost looked like it was going to fall over backwards. And the S&P 500 is looking as if it's also starting to get to that sort of point. And I'm not saying that it's all about to fall over in a heap, not at all, but I'm just saying be aware that it is very, very stretched, and the steepness of that type of trend, often when you get to that sort of steepness, it's starting to signal warning signs, just to be a little bit cautious.
Yeah, because I know you want to bring up a crowd sentiment poll, and I suppose that talks to the steepness of the rally that has been experienced in the last couple of weeks. Maybe those people who missed out in 2017, you know, this terrible crushing FOMO. I think Mark Barnes wrote about it in his column today in Business Day. People just rushing in sort of at any cost almost to get into the market, just to get some kind of return while they still can.
Yeah, that's right. And that's often what does happen, and that's kind of what can cause a blow-off type of move in a market. Now, this chart here is a Ned Davis Research crowd sentiment poll. It's something that I look at quite regularly. And what's interesting to note is that the current reading is it's at the most optimistic level since 1995. This chart only goes back to 2008, just because I didn't want to, you know, make the chart too compressed for the viewers. But but take my word for it that this thing is the highest reading that it's been since 1995. So what it's telling you is that there's a huge amount of optimism that's already baked into the market at these levels. And when that's the case, the contrarian in me does say just be a little bit careful, because clearly there's already massive expectations as to where things are going, and the contrarian view might be just to be a little bit careful.
And because there's another much bigger picture outlook sort of unfolding, and I spoke about it last night, this tectonic shift in the global bull market in bonds over the last 35 years, and the changes that you're going to see in central bank policy and tightening liquidity in global markets.
Well, that's it. So part of what's driven this bull market is massive amounts of liquidity that have been injected into economies and global markets around the world. We've had quantitative easing in the US, there's still quantitative easing in Europe, and the Bank of Japan is also doing it. Now, what this chart shows, basically just look at these little black diamonds over here on each of these bars. What that is showing you is what the level of quantitative easing is, or effectively sovereign net supply of bonds. So if you have a look in 2017, what that shows you is that there was a net approximately $250 billion worth of quantitative easing. In other words, that's where central banks are going into the market. They're buying back bonds in the market, and that money is effectively being injected into the economy. And that liquidity has helped to fuel share buybacks, to fuel economies, etc., etc. Now, the forecast for 2018 is that this quantitative easing is now going to shift to quantitative tightening on a global scale. Obviously, the US central bank's already begun quantitative tightening, but now we're talking about the European Central Bank also beginning to taper it off, and the Bank of Japan is still forecast to ease. But the point I'm making is that it looks this year as if we're going to be forecasting around about $800 billion of tightening. So that's effectively money being withdrawn from the system, liquidity that's being withdrawn. So it's a very, very important point to make, because I think the fact that these steroids, this jungle juice, if you want, of liquidity that's been driving equity markets is now being withdrawn. Just note that, and note the high levels of optimism, note the extreme overbought levels of the S&P 500 where we sit right now. To me, all of this stuff does start to signal a little bit of caution that at some stage in 2018, you actually could see all of this massive bullishness unravel a little bit.
Yeah, and the last chart that you have to keep a watch on is the 10-year US bond and the yield in the 10-year bond.
Absolutely. So this is the one that shows you the 30-year bond bull market. Now, it doesn't look like a bull market. Why? Because this is the yield, and prices and bond yields move in opposite directions. So when yields are falling like they have been for the last 30 years, that tells you that bond prices have been rising. Now, the big names, the bond king, Jeff Gundlach, and also the other bond king, Bill Gross, have both been on record earlier this month as saying that the bull market in bonds is over, and that you're going to start to see rising yields now. The US Federal Reserve is forecast to raise interest rates 3 or 4 times this year. So I think monitor this US 10-year yield very, very closely. If it begins to break this downward trend, which comes in at around about 2.7% or so, monitor that. That would be very, very significant in terms of what it means in terms of cheap money and low interest rates, particularly in the developed world.
I've seen some commentators suggest that it's all fine until it gets up to about 5%, which would seem incredible at this point, but other people poo-pooing that that's could be well before that you start seeing big ructions taking place in global stock markets.
Yeah, well, I think the point is that it's what happens to this cheap money. That's the point. And if money's no longer going to be so cheap, what does that mean for economies and for equity markets?
Yeah. Just talking about equity markets very quickly, a look at the top 40, Garth.
Yeah, so here's our top 40 future, just to look at it locally and bring it back to where we are based in South Africa. It does still look fairly bullish at the moment. This triangle pattern that I've got over there is broken out to the top side above 53,800. So that's a bullish development. And it points to a move up to about 54,500, maybe a little bit higher. So I think keep an eye on that. That still looks fine to me at this stage from a bullish point of view, and there's certainly in the immediate future anyway.
The Cyril Ramaphosa rally, with the rands, one of the factors there.
Yeah, so here's a chart of the rand-dollar exchange rate, very, very important. Obviously, that massive move stronger in the rand at the end of last year came once Cyril had won the ANC presidency. And you can see now it seems to be stuck in a range between 12 Rand 25 and 12.50. It's looking possible that it might actually break stronger below the bottom of that trading range, which would probably bring 12 Rand and maybe even 11 Rand 80 into play. So it certainly looks as if the bullish sentiment is on the side of the rand at the moment.
Yeah. So, Garth, to end off the show, just a look at, you've got a couple of courses to start off the year.
So 2 courses coming up in February now. I'm running a high probability trading course on the 3rd of February, and my colleague Andrew Todd runs a top 40 trading course that's on the 17th of Feb. So anyone that's interested in attending either of these courses, please send me an email, garth@traderscorner.co.za, and we'll send you all the details.
And then just as it's going to be a more vigorous year, people want in on the action, won't they?
Yeah, that's right. So we have an email list, which is a free mailing list that people can subscribe to. If you go to traderscorner.co.za, you go to the middle of the page, you'll see there's a link there for a free weekly email. Sign up, register, it's quick and easy to do, and we'll send you an email every Tuesday detailing what trades we're doing and what is coming up on the show for each week.
Great. Garth, we'll leave it there. Good luck to us for the year ahead. That is Garth McKenzie, founder and editor of Traders Corner.